So what is this 1031 exchange?
Yeah. So when it comes to syndications, there's two ways or two main ways of getting this done. It's through a DST or through a TIC structure. At Lone Star Capital, we don't do a DST structure. So that is more common, when you're you're a smaller investor into larger projects that you have less control in. With a TIC structure, you're actually a tenant in common, which is how the requirement to actually own direct title to property gets satisfied. So with a syndication, if you're just a regular passive investor, you're investing into an entity that owns and manages another entity that actually owns the property.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. 1031 exchange. If you're like me, you've probably heard of this before, but I've only related it from maybe single family. Sometimes, we can do some multifamilies. But today's conversation is very interesting, very unique. I've not had any discussions like this before. We'll be talking about how we can leverage the 1031 exchange into a syndication style arrangement. And it's very particular how this has to be structured for it to work. Today's guest is the Director of Investor Relations from Lone Star Capital. Now, Lone Star Capital is based in New York City or New York, but their portfolio is in Texas. Some gorgeous properties. And today's guest is actually in the process of writing a book on this 1031 exchange idea and the structure of it in the syndication process. Everybody, please welcome Dasha Beardsley to the show. Dasha, welcome to the show all the way from the Lone Star State. Is that correct?
No, we're actually in New York. All of our
Come on with it. And the
Texas.
company's name is Lone Star Capital.
Yeah.
How does that work?
Well, we started the company in New York. That is where the two principals lived or wanted to live. And we liked the markets in Texas. And a lot of our strategy is just being super focused in our geographical markets. So that's kind of how that happened. But it is a little silly. So we do have our property management company that's in-house that is obviously headquartered there. But kind of our private equity side of the business is in New York, which has worked out well as well for, equity relationships and things like that.
Beautiful. So Dasha, first of all, thank you for your time. Thank you for coming on the show today. I'm excited to talk a little bit more about something particular that I haven't got the chance to talk about when it comes to tax advantage and syndication, and how there's something out there that we can leverage to bring us even more happiness in this process. So before we get there, without unloading too much of that, Dasha, tell the listeners a little bit more about you and your background and what you're doing today.
Yeah, well, thank you so much for having me on the show. I'm definitely excited to talk about all those tax advantages and things like that. As far as my background, I do come from a real estate family. I went on to receive my real estate development degree from USC. That's Southern California, not South Carolina. And I have been working for Lone Star. I started in college, so it's been about 3.5 years now that I've been with the company. We do multifamily acquisitions only in Texas. And I'm the director of investor relations, but my focus also expands to marketing and more kind of the transactional and legal side of the business as well.
Nice. And in this Lone Star State, we're joking around a little bit when we first got started here. I'm looking at the portfolio for Lone Star Capital, and I'm seeing, three major areas in Texas being San Antonio, Houston, and the DFW, Dallas-Fort Worth area. And the company's located in New York. and you are all the way on the other side of the United States, USC. And how did you end up in New York? How did that, and then you've got all 3 points of the United States there. How did you end up in New York?
So my brother started the company when I was a freshman in college. So I was always pretty intrigued. I was investing I had other jobs in college, and so I was investing whatever money I had into Lone Star deals. And then I kind of just slowly worked my way into a full-time job. Wasn't really ever the actual plan. I just started out with like an internship after my freshman year, and then kind of my brother and I would brainstorm and things like that. And it just ended up working out very well. I kept growing, and he kind of eased me into it without me realizing. So by the time that I was graduating college, I'd already been fully immersed into the business. So it just made sense for me to move over to New York and start full-time in office with the rest of the team.
And I see another Beardsley in the office there. Who is that? Is it Ina?
Yes. So that is actually a very recent addition. So simultaneously, so in 2018 was when my brother and his business partner, Kent, who is the other partner of the company and other principal, they bought their first deal in 2018. That was when I was a freshman in college. Simultaneously in 2019, I think it was, my parents bought their first multifamily deals in Texas, which Lone Star had found for them. But it was separate. So my parents ran their own properties, did the property management and things like that. We just are, I guess I wasn't really involved at the time, but Lone Star Capital helped find and acquire those properties for them. So my parents got a wealth of knowledge, particularly my mom, in running properties, very, very cost effective, and all the kind of the best practices, and really innovating a lot of the sort of typical or standard practices of property management. You know, everyone says property management is just very difficult. Incentives aren't aligned and things like that. So my mom has really, when it's your own investment and every single dollar that's coming in and out, you do end up treating it a bit differently as a property manager. So she's just helping us now. She started a couple months ago, actually, working for the firm as the COO and just implementing some of those strategies to just really boost our cost effectiveness and increasing our ROI for our investors.
Yeah. And being hands-on is very similar to my situation. So in our portfolios, my wife, Erin, manages the inside, and then I manage properties, for other clients as well too. So know what it takes to keep that dollar and hold on to that dollar like it's in your own pocket. And yeah. I think every operator out there who functions like that, it's a different level of integrity, I think, when you can hold on to that dollar like it's in your own pocket. Very, very cool. So the family biz, huh? That's cool. That's fun. Is your mother in New York too, or is she somewhere else?
She's kind of part-time here. I mean, she just started, so that's we're still figuring it out. But yeah, it's funny how it kind of turned into that. A lot of people assume that it started out being a family business when it was really just my brother and his business partner. But my brother's kind of slowly bringing us all into it.
Okay. So I want to dive into this thing that you've been researching lately, and you're actually going to be writing a book on this as well too. So very interesting. We're going to talk a little bit about the 1031 exchange in relation to this passive style investing, the syndication type of investing. So give us a little introduction on what that means to you. First of all, full transparency. Gotta love the disclosures. Neither of us are CPAs, accountants, or attorneys. And I've never used the 1031 platform to kick the can down the road, they say. So I've never done that personally. I'm not a CPA. I'm not an accountant, anything like that. But some of this experience that you're sharing has been firsthand working with clients through the process, correct?
Yep, exactly.
Awesome. So what is this 1031 exchange?
Yeah. So when it comes to syndications, there's two main ways of getting this done. It's through a DST or through a TIC structure. At Lone Star Capital, we don't do a DST structure. So that is more common when you're you're a smaller investor into larger projects that you have less control in. With a TIC structure, you're actually a tenant in common, which is how the requirement to actually own direct title to property gets satisfied. So with a syndication, if you're just a regular passive investor, you're investing into an entity that owns and manages another entity that actually owns the property. When you are a tenant in common, you're actually a tenant in common with the operator who owns the property. So you actually are owning a percentage of the actual real estate. So that is super important. If that's not the case, then it's not going to be a valid 1031 exchange. The kind of complications that come with doing a 1031 exchange into a syndication is that it can't be a partnership. So it's a little bit of a gray area, and you have to be very careful in structuring these 1031 exchanges, because if it is seen by the IRS as a partnership and not actually a tenancy in common, your exchange could be invalid. So it's super important to actually consult a tax attorney and work with a group that is experienced in accepting 1031 exchanges into their syndications and that you feel comfortable with, because there is some gray area with the partnership side of things. So that's kind of a high level overview and the complexities, and I think part of the reason why a lot of people don't know to do it is because of those complexities. And, a lot of sponsorship groups, operators don't accept 1031 exchanges because it is a bit more complicated to do. But early on in our growth, we decided that was something that we wanted to do and be able to offer to our investors. So we feel super comfortable and have been doing a ton of them over the years.
So what does DST stand for? TIC, you call the TIC, tenant in common. What does DST stand for?
A Delaware Statutory Trust. And it's a interesting name because it doesn't mean that of course, the real estate has to be in Delaware or anything like that.
Delaware Statutory Trust. So what I'm hearing is syndication, and we're talking about the syndication, right? What you're moving it into. It has to be in the TIC structure versus the DST structure. So is that correct?
That would be just for us. So you can still, as a 1031 exchange investor, a DST is definitely a valid way to do a 1031 exchange into a syndication. It's actually overall, I would say, more popular. It's more common for the DST minimum to be a lot smaller because you're not actually, a tenant in common. Actually, you're investing into a trust. So the minimums are usually, I would say, about 100,000 versus with a TIC, can definitely vary by the group, but I would say it's closer to $1 million.
So the minimum investment is $1 million on the TIC.
I would say that's the average for sponsorship groups accepting 1031 exchanges. For us, it's usually about 750,000.
So if I were coming to you, Dasha, and I said, hey, I've got these funds, I want to invest in one of your multifamilies in Texas, and I would like to entertain the 1031 exchange idea, how much money do I have to have? And what does that process look like then? I mean, because if I'm selling a structure, say I'm selling a structure, and I want to take those funds and put them into an investment, a syndication with Lone Star. What's that look like? What's the timing of that? Do I have before? Do I have after? And then is it similar type structure when I have as any other syndication, the document, the paperwork, the requirements?
Yeah, that's a great question. So the process in a lot of ways is similar, but it is definitely a lot more document intensive, and it's much more sensitive timeline wise. So for example, I'm not sure if you've experienced this before, but with a syndication, the deal could technically close and then the sponsorship group could be raising funds post-closing for, to fund their CapEx or something like that. That's typically not really an option for 1031 exchanges because you would actually have to do a loan modification since this investor would be holding direct title to the property. They are going to be a borrower on the loan. So there's just more lender requirements associated with doing a 1031 exchange in the TIC structure. But starting from the top, basically, once you sell your property and you're looking to 1031 exchange, you have 45 days to identify a property that you'd like to invest in. Typically, the rule is that you can identify 3. There's a few caveats where you would be able to identify more properties to potentially close on, but there's some rules with that I won't bore everyone with. But so basically you have three properties that you can identify, and you just need to close on one of them if you want to go through with your exchange. So you have 45 days to do that, and then you have a total, since the day of your closing, you have 180 days to actually close on the next property that you plan to exchange. So for that reason, like with the identification period, the timeline is a lot more sensitive, and so it's a bit harder to line up with a group. So I would say if you're an investor looking to sell a property and you'd like to do a 1031 exchange, I would reach out as early as possible ahead of time of the sale of your property and just see what options are out there, figure out and kind of narrow down what type of property you'd like to replace your down leg property, and talk to different sponsorship groups because, for us, we don't always have an opportunity that is 1031 exchange eligible. And so it's good to basically talk to more people, figure out what all your options are, and be ready because that clock starts ticking right once you sell your property.
Mm-hmm. And the minimum investment you're saying is I've got to have at least $750,000 to put into your investment.
Exactly. For a 1031 exchange, that's correct. For our regular syndication limited partner, minimum is $50,000.
$50,000. And when you say tenant in common now, in my mind, I'm seeing like these structures of a bubble, like almost like a bubble diagram. This entity that is the syndication, it invests into, say, Lone Star 1, 2, 3, 4. Right. This is kind of like a general hypothetical syndication process where Lone Star 1, 2, 3, 4 is the operator of the property. And to me, it sounds like the tenant in common then is not in that other bubble of the syndication. It's direct partnership with Lone Star 1, 2, 3, 4 on the property itself.
Exactly.
Interesting. And does that, what about again, I understand you're not an attorney, I'm not an attorney, but what about liability issues then? Because I feel like that would put me more at risk because my name's on title as opposed to being somewhere down the line in these syndications.
Yeah, that's a great question. So we actually it's not the actual individual that is going to be the direct owner of title in the property. So we create a new fresh entity. We form a new entity for our TIC investors. And so we are non-member managers of those entities. So of course, we have an operating agreement between our investor and the operating agreement for that entity that we create that will actually be the direct owner. And so that basically allows us to be the managers of those entities. And that really reduces the liability of our investors as individuals. And so we're actually the ones who sign on the loan. But technically those entities are still borrowers on the loan. So,
and going back to the first, I think you called it down leg, the first piece of this that I'm selling, that building, if I've got the 750 that I'm going to invest with Lone Star, and I want to do a 1031 because I've got a lot of capital gains, saying maybe I've held this building for 10 years and it's doubled, right? I've got my 2x multiple in there, and so I've got 300 and some $400 $1,000 that instead of paying taxes on, I want to roll that over into this property. Now, saying I have it free and clear, which means my cash from close maybe around 700,000. So all of that 700,000 has to go into this new investment, right? And then the value has to be similar or greater, in which the value of the investment with Lone Star is going to be much greater. So this would work in this particular scenario. Is that correct?
Well, so the value would be how much you're investing. So since your ownership percentage, your investment,
It's not the value of the building. It's only of that percentage.
Right, exactly. So like, let's just say, I guess just to clarify, if you sold your property, it's free and clear, you have 750,000, and then you only ended up investing 300 of that into our property. Even if our property was 50 million, that would not satisfy the need of the equal or greater requirement.
Right. Okay.
Yeah.
I see. So it has to be, you're giving it the ownership of the amount of money. So it has to be, that entire transfer has to be into Lone Star, into the partnership of the new entity with Lone Star.
Well, it's interesting also because this was a misconception that I had before I got more involved in actual 1031 exchange transactions, is that technically you can actually, if you wanted to, only invest, you don't have to invest the total amount. That just means that you would have boot is what it's called, and that kind of remaining amount that is not transferred over into the next property, that's taxable. So of course, you want to probably avoid paying all the taxes, but if in some case the property that you're looking to exchange into is somehow a little bit less in value, it's not the end of the world. It's still worth doing the exchange.
Yeah.
Yeah.
Interesting. I had a property that we had considered doing this with, and originally paid $245 for it. And when we sold it, I think we sold it for like $330 or something. So we net out about $300. I had a private money loan on this property for $300. So I basically had no cash, in no cash from the transaction, but I'd be showing, a $60,000 profit that I would have to pay taxes on. So the interesting piece, I could have found a place to do a 1031 exchange, but I wouldn't have had to have no money into the deal in order to get the exchange. So I don't know how that would, how would that particular scenario work with Lone Star? So I have no money that I have to spend, but I have to, and that would depict the value or the amount. I'd have to at least need to be 300. So I'd have to put in 300 of my own money in order to make that exchange work.
So the way that it works, so I'm assuming what you're saying is that you have no actual money in that property is because it's all debt?
Yes.
So when you do a 1031 exchange, not only does the equity portion need to be exchanged, but also the debt. So that also, let's go back to the other example with, let's just say you have $750,000. You just sold a property. It's free and clear. There's no debt on the property. You go and exchange that with us. You're still allocated debt proportionally to your ownership percentage of the property. So, I mean, we're leveraging on this property. We're using debt where we have a mortgage on the property. And so since you're a borrower, since you would be a borrower, you would be allocated the proportional amount of debt to your ownership percentage. So then this could be, I guess, a negative to doing a 1031 exchange into a syndication if you do own your property free and clear and you'd like to do that going forward. Because then if you invest $750,000 into our syndication, then you get allocated debt. And then on the back end, if you want to exchange again, you'll have to replace that debt as well. You can also, there is flexibility there. It doesn't necessarily have to be debt, or you can just have a total greater value when you could also replace it with just more equity on the next property. But just to keep things simple, you are allocated debt and then you would have to exchange that on the back end. So in your case that you brought up where you are, when you would have it all, the whole property is debt, you would still have to replace that total value. So you would have to invest and replace that debt. So it wouldn't be the entire amount because you'd be allocated debt from us investing in it, but you would have to actually put some dollars in order to get that debt allocation.
And then on the debt side, if I'm partnering with Lone Star, probably in different entities, but if I'm partnering with Lone Star, how do I still have to qualify as an accredited investor to do this? And no, I don't have to. She's shaking her head for the listeners.
No.
So I don't have to be an accredited investor to do this because it's a tenant in common. It's a tenancy in common. So it's a direct partnership, basically.
Right. It's not like a 506c offering. You're not investing into that entity that would be making a 506c offering. Right. So there's no accreditation verification involved.
And then I would have to sign as well, depending on the ownership, or does it depend on the amount of ownership? Because sometimes there's up to a certain amount, whether it's 10% or 20% or whatever it may be, of ownership in entities that person has to sign on the loan. But it sounds like that person who's doing the 1031, if I bring the 750,000 over, I'm also going to be signing on the loan. Is that correct?
It depends on how you structure it. So, as I was mentioning earlier, we structure it so that our investors don't actually have to sign on the loan, since we're managers of the entity that we create together. So if an investor comes to us, they say they want to do a 1031 exchange, we form a new fresh entity. That's a lender requirement as well. And so we, as Lone Star Capital, we become the managers of that entity. And so we sign on behalf of our investors on the loan.
What is the average deal size for Lone Star Capital? Do you know offhand?
The purchase price?
Yeah.
I would say we've been doing a little bit bigger deals recently. The past however many deals have been about like 30 to 50 million.
30 to 50 million. And of those, I guess if there is a normal or a typical or an average, how many TIC partners do you have? Like how many 1031 exchange partners is Lone Star Capital interested in doing? Because this could get extremely laborious with the paperwork.
Yeah, well, luckily I love 1031 exchanges, and I'm usually the one who's doing most of the work. So we're happy to have as many as we can get. But I would say it really depends. You know, we had a deal last summer, which is when I really became super interested in TICs. We filled up the entire equity stack with 5 different TICs. So that was pretty cool. It was a smaller deal for us, but still we were able to fill up all the equity with that. So that was, very simple. You only have 5 investors to talk to and work with on a deal. So it was pretty cool. But then we also, because of the requirement of a 1031 exchange for them to own direct title to the property, we do one kind of our bread and butter is a tax exemption deal. Unfortunately, those deals are not eligible for 1031 exchanges. So most of the deals that we've been doing in the past year have been tax exemption deals, which we are not able to take 1031 exchanges. So it really depends. But I would say the deals that are eligible, we have more of them because we have a decent amount of demand for 1031 exchanges. So it kind of sucks having to say no just because of the structure won't allow it.
And when you say tax exempt deals, what does that mean? We've done a few different types, but the one that we have done most often is in partnership with the Houston Housing Authority. And we basically give modest rent restrictions in exchange for property tax exemptions. Yes, I've definitely heard of those before. And when you do that, there's no 1030. It's not 1031 exchange eligibility in those deals, is what you're saying.
Right. Because of the way that it's structured in partnership with the Houston Housing Authority. So the TIC investors aren't able to actually hold title directly to the property. So it just disqualifies that, unfortunately.
Interesting.
Yeah.
So modest rent restriction, what does that mean?
It depends on the deal, and it also depends on the market rent or where the current rents are at the properties. But usually the rent restriction is, or not usually, it's always based on the area median income. And that is also reassessed every year. So it really is, I think it's a great program partially because of that. Because there isn't just like a rigid, oh, you can only increase rents 2% per year, or, or you're maxing out. It's really just dependent on how that area is doing with their median incomes. So, usually it's split up where we have to allocate a certain amount of the units to 60% of the area median income, or 80%, or it's a combination. So, it kind of changes deal by deal of the agreement as well.
And then the tax exempt piece, is there a time limit on that? And what taxes are exempt? Is it the real estate taxes?
Yes, it's property taxes, which is, a huge expense in Texas. So it's great to have that benefit. The program goes on for 99 years. However, we don't have to stay in the program for that long. So if for some reason it becomes less accretive to be in it than out of it, then we can, after a certain time period, we can exit the program.
Very interesting. Wow, there's a lot there, and I'm just looking down through the portfolio, and man, these are really nice properties. So if anybody is interested in learning more about Lone Star Capital, even connecting with Dasha on this, it is lscre.com, lscre.com. Lone Star Capital, I'm guessing real estate, lscr.
Yep.
E.com.
There's a lot of Lone Star Capital, so we had to make it a little bit
differentiate. Yeah, throw that RE on there. So I'm looking at this portfolio here, and it looks like really, really nice properties. So even in these really nice properties, or is it certain areas that these tax exempts are available? It's not necessarily in the lower income areas.
Yeah, exactly. The mission is to preserve affordable housing, but on the nicer properties, the area median income is usually higher. In some of these areas, the median income is very high. So it's all very kind of proportionate to what's in the area. And in certain cases, the goal is to preserve affordable housing, but in certain cases, we don't have to even lower the rents in those restrictions. So we're already meeting that. In cases where it's already kind of a naturally affordable property.
So in hypothetical scenario, if you're keeping 60% of the rents within the tolerance of the tax exempt stipulations, that 60%, that's what the real estate taxes are being reduced by then?
No, so, and it does depend on the deal. Like earlier deals that we did in this program have a different sort of allocation, but usually it's just 50% of the units are allocated to be rent restricted. And then within those 50%, we have certain restrictions for individuals making 60% of the AMI or 80% of the AMI. So if we're restricting the units for the 60% of the AMI bucket, it's going to be a little bit deeper of a rent restriction than the 80%, for example. But none of these properties have more than 50% of the units allocated to rent restrictions. And usually the deals that we did the program on prior, like I'd say last year, up until end of October, we were getting 100% property tax exemptions. Now it's typically 85%.
Wow. So not paying property taxes at all on a $30 to $50 million property. Wow. That's amazing. I've got one more question for you. I'm on the website here, Lone Star Capital. So it's lscre.com. And I see the beautiful pictures of everybody on here. And I see a few gentlemen in here that are called asset managers. What do they do?
So we break up our portfolio between these three asset managers. And so they are responsible for their properties. This is, kind of a more recent change to our org structure that we have done. So our asset managers work directly with our on-site teams. So they go down to Houston, San Antonio, Dallas often and work with their community managers, or we call them community managers instead of property managers.
Mm-hmm.
They work with those teams day in and day out and are really responsible for their properties. So they help out their community managers. They also help with our reporting and things like that. They do a ton of stuff. It's, with property management, when you're really involved, there's endless things to do. And so with almost 20 properties now, definitely need a lot of manpower on the operations side.
Awesome. Well, I think that is a great introduction into Lone Star Capital. And Lone Star Capital, that's based out of New York, right? And Dasha went to school at USC on the other side of the United States. But a great introduction into the company, the portfolio, and this 1031 exchange idea. And again, this is new for me. I mean, obviously, I knew that it was out there. I just have not had a detailed discussion like this on the syndication style. With the requirements on that. So thank you so much for your time today, Dasha.
Yeah, thank you so much. It was great chatting.
Awesome. And to the listeners out there, again, today, if you want to find out more about this very interesting idea, more about Lone Star Capital, that's lscre.com. I was just perusing around the portfolio there, some beautiful properties in Texas, gorgeous properties. And this tax-exempt idea and the 1031 exchange idea is very interesting. Awesome information from Dasha. But again, thank you for your time and your attention today. This is the Real Estate Mogul MD.